Andrew had his hand raised, but Siam had it raised first. I will not skip any of you, by the way. Even Bumper that doesn't have his hand up, I will call on all of you. But let's go ahead over to Siam first, so I just can follow the order that people raise their hands in. Go ahead. Is there something that you would like to add?
Yeah, I think we need to start a little bit higher. So I always look at any new topic with sort of standard distribution in terms of the populace. So if you look at the general populace of any country, everyone within 2 sigma, which is about 95% of the population, they are all obsessed and have somehow fallen into the cult of diversification. And one thing when you look at the history of money and wealth and the flows from money and wealth is that everyone within 2 sigma of standard distribution, they are not rich. They are literally the majority. And diversification literally never gets you wealthy in a time efficient manner. Now, I'm not a fan of Warren Buffett, but the one thing I do agree with him is he says that diversification is an exercise for people that don't know what they're doing. And I know this is a bit of a controversial stance, but bear with me.
Good. We like those.
So diversification in life in general is pretty pants. And most people think that they're doing it, but they don't. So the average person, as in everyone within 2 sigma, they've got a job, which is basically everything revolves around the number 1, which is the worst number in finance. You don't want one income stream, one job, one business, one product, one member of staff, one bank account, one of anything. Yet most people are they end up with the number 1, and they've got a job which they think is safe, but that's just one income stream. Now, I used to be an Air Force pilot, and one of the things that really stuck in my head is that you have to use the correct weapon for the correct target. And so in the investment world, you have to know what your end goal is. So some people don't even want to be a millionaire. They just want $2,000 a month and they'll be happy as Larry. But if you are, I don't know, let's say like myself, I've got a certain number I want to hit for. My CAGR, my compound annual growth rate, which I need to achieve that in a time efficient manner. So for me, a time efficient manner is within 10 years. You'll end up with, something like 50% CAGR or 100% CAGR or whatever. Now, when you then analyze the whole world of, okay, let's say your CAGR to hit your 10-year target is, 50%. That immediately filters out an absolute bucket ton of assets. It's not stocks, it's not bonds, it's not property, it's not a job, there's loads of things that it isn't. And so this way, I think perspective is everything. So for me, let's say my personal CAGR is 50%. That leaves me with business and crypto. So about, 12 years ago, I was like, oh, holy shit, I need to leave the Air Force and become a business owner. And then I got into M&A because M&A is like the next step up from business. So you've got to pursue the relevant CAGR, as in the relevant vehicle for the CAGR. Now, drawing this back into crypto, sort of the tenuous link here, is that the amount of money or capital you put into any asset should be directly proportional to the amount of knowledge you have in that asset. So most people that play around with crypto, they'll just buy the top 10, top 20, or a basket of random coins. And I could pluck any crypto person off the street and that has crypto and say, hey, why did you put money in Polkadot? I don't know, for example. And they'll say blah 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 blah. But everyone has a thin surface level of knowledge of their bag. Like, very few people that I've met can actually talk in deep depth about why they're in what they have. And it's because people have just diversified. And so when you put a bit of time into the markets and cycles and all that sort of stuff, like, you can very easily time certain things. So for example, we're now coming out of one of the worst bear markets we've had in a long time, and we're in a nice sort of, because in essence, when you look at the halvings, which is the only real constant, we have a 4-year cycle. It goes up for a year and a bit, down for a year and a bit, sideways for a year and a bit. So we're in that sideways bit now, leading into the next halving, etc. So in every halving, or every period that since Bitcoin's been around in this sort of sideways accumulation zone, the Bitcoin always booms out of the bear market first. So if you're just spreading and betting across everything, your Bitcoin will do well and your alts will be left behind. So you've got to look at assets in terms of a seesaw. So at the moment, when I look at Bitcoin against alts or Bitcoin against ETH, it's highly probable that Bitcoin will exit or start the bull market first, and then 6 to 12 months later, alts then really get their running shoes on and then massively outpace Bitcoin. So for the more, I guess, conservative person, I guess you could just be all in on Bitcoin in terms of your crypto bag, and then just watch that Bitcoin ETH chart. But yeah.
Right. Well, the other prevailing wisdom, Christopher, I'm going to go over to you from Pioneer. Thanks for waiting. We've got.
If you don't understand them, you can lose. You can lose surprisingly with stop loss because you just hit the wrong spot.
Yeah, definitely. Siam.
Yeah, I sort of agree and disagree with some of the stop loss type stuff. I think it needs a bit of context because in crypto you really have, well, it depends how active you are, but there's 3 ways you can approach it. You've got your spot hodling where you're buying the core, like Bitcoin and then hodling it somewhere safe. You got some positional swings where if you're aiming to get in and out over, key certain levels, and then obviously for those that want to be more active, you can do regular, perpetual derivative trading, etc. But I am not a fan of stop losses at all, and the reason being is I'm normally the other. So there have been many times where I've actually used my stack to go stop hunting. And someone said just before how they've experienced where they've just been wicked out on a stop and then the market buggers off without them, etc. And that's because there are other traders actively looking at the order books going, there's lots of volume here. If I then start dumping or selling or driving price into that area, it will start a cascade of sells or buys depending on what you're doing. And then you can then trigger in some entry orders that you're driving the price into. And that's why very often you'll get wicked in or out and then market buggers off because there's someone on the other side of the trade that has actively perpetrated that move. And so, but the main reason I don't like stops, so going back to the stops, it's worth having a hard. So let's say you're placing a trade and you want to risk a maximum of 1% max risk on that particular trade. It's worth setting a stop loss on that at the level for 1% max risk, but you need to have in, let's say, a mental sort of price alert at say 0.5% max risks. So that means you can then reassess if you want to pull out before you go -1R or not. But the main reason I am a massive not fan of stops is that if you're having stop losses, it means you are leaving your assets on the centralized exchange, which is like a mortal sin in crypto. I mean, if you haven't already seen, FTX has gone bust. I mean, there's so many exchanges that have just shat their pants. So the main rule of crypto is buy your spot tokens and then get it into your own cold wallet. Do not leave assets on the SEX. So that's just my little context behind that.
Right. So you're a believer in not my keys, not my crypto.
Hell yeah.
Okay, Siam, let me take it back over to you.
Yeah, just a quick one. I echo what Chandra just said. It really depends on, I guess, on your conviction of it, and also not to just hodl blindly and naively, which is what most people do. Like a prime example was that I used to be a big fan of Olympus DAO back in the day, and I was in it back in the day, like 2021, and we rode that up. But one thing I've always said to everyone is, it's very easy to just draw base support lines, as in the major base support levels on any asset. And if you have a major base support breach, you need to get the hell out of there. And so, like that Ohm example, I exited at the base support breach at like 9.50, but I still meet people to this day that are still riding Ohm down, and it's now $10. So just like a little bit of extra education or investment into your own knowledge in a asset really does help. But also the other, going back to like Michael Saylor and whatnot, I mean, BlackRock, the biggest asset manager on the planet, and Fidelity, they're all now jumping in like sharks to try and get their own spot ETFs approved. That sort of gives us an indication that Bitcoin and ETH are going to be around a fair while. So, yeah, take with that what you may.
It's an excellent point. Let's see. Right, perfect. Siam, what's your advice to kind of close this out with?
Yeah, I guess big long answers really. I heard someone say, seeking advice. I'm a massive anti-fan of that. You must not be a person that seeks advice. You need to become the person that doesn't need to seek advice. And I think saying similarly to what Megan said, you need to actually put some time in and know this. So for the average investor, I guess, get a basic understanding on on-chain analytics because they help give a rough ballpark of the state of the market. It won't give you the exact highs and lows. I mean, it's never good to be a top picker or bottom picker in the markets or in real life, I guess. And then also understand tokenomics. So when you're reading into a project, if there's I looked at something recently where basically it was a massive pre-sale. It was VC galore, and it was evident it was going to be a massive dump. And guess what happened? So understanding tokenomics, and then tokenomics spill into the real world. So for example, I think it's fair to say it's almost a fact that for as long as humans are around, there's going to be governments and banks and whatnot, and humans will nearly always have this never-ending expansion of the global currency supply. Just look at what the dollar against the Argentinian peso. That's what's going to happen to the US dollar and every other fiat currency. So what is the answer to that? You need something which is hard money, some deflationary, if anything. So get your head around that. And then the next thing is always go to where the puck is going, not where it is right now. So at the moment, the trends are obviously AI over the next God knows how long. Real world asset tokenization, that's going to unlock a good $250 trillion worth of illiquid assets. So it's worth going into that. And also the infrastructure. So don't forget, crypto from day one has really been an inadequate tech where we've just bolted on with sellotape and glue to try and make things better. That's why we have layer 2s, layer 3s, because the layer 1s are all pants. Like Arbitrum, etc., being a layer 2 for Ethereum, it's because Ethereum sucks in many ways. I'm not saying it won't go up in price. So, there's a big explosion in block DAGs. It's worth looking up Jonathan Sompolinsky. I mean, he's most of his protocols are in all the coins out there, like Ethereum, ADA, AVAX, all that sort of stuff. So, I guess the overriding principle is just literally plow 100 hours of research into crypto into your own education.
Right, definitely. So, that's good advice, isn't it, J-Rod?